think, we entered this period, a bit more defensively than we, typically have. Typically, we're cautious, but we felt a little bit more defensive this year. Entering the year, we saw the combination of sort of a peak fiscal policy under President Biden, and we saw that flanked alongside, peak monetary stimulus with the Fed. And that's a unique combination you don't see very often in the markets. It's a lot of fuel to the fire, and it's something where the combination of that, whilst seeing a bit of inflation and whilst valuations were sort of at a high end of a longer term range at 20 times forward earnings, was something that sort of just gave us pause. So, when we get pause, we tend to get a bit more defensive, look for those names that have the ability to sort of grow on a steady basis under different backdrops and sort of focus the portfolio in that direction. So I think valuations, I mentioned the market was trading on roughly 20 times forward earnings. The North American Income Trust, has traded between 13, 14, 15 times forward earnings. So a bit more defensive from a valuation perspective, as well as paying a sort of progressive dividend yield with the underlying stocks in the portfolio yielding roughly 3.5%, being able to grow that dividend at sort of a mid to high single digit rate of growth over this period. So I think, when we look at that, when the cost of capital, during the pandemic and arguably pre-pandemic, was negative, with very low interest rates, if not a zero interest rate policy. And now it goes to something that's a little bit more substantial. Valuation matters a lot more when rates are higher. And I think the market has seen that over the course of the year. But we're very much, disciplined, and valuation matters a lot. And I think that's something that you should always look for when you look at the very best holdings of the North American Income Trust. And when I say very best, it's a concentrated portfolio. It's a best ideas portfolio, 35 to 40 stocks. And we typically have that well-diversified mix of companies. And right now, sort of our biggest pillars of the portfolio are healthcare, whether that be health insurance, whether that be pharmaceuticals. We have that on one side. We also have some high-quality financials. So we do have a couple banks, but we also have a couple other companies that are much less interest rate sensitive. So it's something where we see a good mix of companies, good balance sheets, good managements, and good culture at these companies. They're the companies we like to invest in over the long term. We also have a modest overweight to energy, but again, we're not betting on the oil price here. That's typically not what we try to do. Obviously, oil companies are tied to an oil price in the financial wherewithal of those major oil companies. But right now, we spend a lot of time with oil services, refining, midstream assets, and also chemicals. I did look back at past performance. We try not to look back at performance. We try to be a little bit more forward looking, and not rest on our laurels or the opposite, be depressed by past results. But when we look back at the third week of October, the trust was up on an NAV basis roughly 6%, and that compares to our benchmark, the Russell 1000 Value Index, which was up just over a percentage point. And then because we've been able to narrow the discount a bit, we've seen share price actually up over 10% this year. So we've seen good, strong relative performance and decent absolute performance. And I think what's important, because this is an income trust, we've been able to pay a dividend all 10 years of the trust since we've converted it. And we were just named a next generation dividend hero by the AIC. Revenue reserves are a year, and they've been a year for the past couple of years. And I think importantly, looking forward, once again, we put the board in a good position to not only increase the dividend on an annual basis, but maintain that 1 year of revenue reserves. Following a couple of years of sort of increased volatility in and around the pandemic and even coming out of it a bit, things have toned down a bit for us. We've had a few changes in the fund. Typically, the turnover in our fund isn't trading in and out of ideas. It's rather looking at those best ideas. And if a couple of them trade at sort of a higher end of a fair value range, to top slice some of those. And if we have some laggards where we feel the underlying fundamentals are good, or the market's penalizing them for something that we would deem as short term, we tend to top those up. So that's when our turnover has largely been focused in this year. One example of a company that we did exit was a company called Union Pacific Railroad, a long-term holding of ours. And simply put, valuation there got to a bit on the high end. We saw in markets that they do business with as beginning to weaken. So there was a little bit of a disconnect for us there. And when we only hold 35 or 40 stocks, we can be very picky in the ones we own. and we saw some better ideas elsewhere. So simply, a name like Union Pacific, we exited that out of the portfolio, and because it's a high quality operator, because we like their business model, we simply put that to a watch list and keep an eye on that. And if the combination of valuation becomes a little bit more acceptable to us, if we see end market performance begin to level out, that's a name that we can surely reintroduce into the portfolio. Well, interesting and exciting typically don't it isn't the feedback we get when we look through our 35 to 40 stocks, but I find them interesting if they can grow earnings, pay a progressive dividend, and sort of sustain that over long periods of time. And we have a couple examples of that I'll share with you today. One of them is MetLife. It's a company that we all probably know. Um, they dominate the group benefits market, which includes life insurance and other bits of benefits that you get in your package as an employee. And it's something they've been able to do not only in the U.S. but to do this globally. And it's a high margin, cash generative business. They have great pricing power, and they've been able to expand this and have some great worldwide partnerships with their business. And when you look at it, what they've also done from a business perspective is they've been able to spin out some of the lower quality businesses. So they exited the annuity business over 5 years ago. So it's a company that is focused on the best parts of the portfolio and still trades at a very, very cheap multiple, 8 times forward earnings. The dividend is roughly 3%. And it's something where we actually see the ability here for not only the multiple expand, the dividend will grow. And that's a name that's very much a pillar of the trust. Another on the other side would be something like Merck. It's a name that we've introduced recently, and what we found with Merck is not only a great suite of drugs, we saw a solid pipeline, great cash flow, and a good balance sheet. And typically in healthcare, in pharmaceuticals, you can either create a drug or you can acquire drugs. And they have the ability right now to do both, and they can do it in a very disciplined manner. They have a great history of execution, and Merck's a company that we've looked at for quite some time, and valuation finally got to the level we felt comfortable at roughly 10 times forward earnings, and we're able to enter that into the portfolio. Well, I think we know that the macro backdrop is a little bit difficult right now. We see high inflation, we see cost elevated, we see wages higher. So I think for us, we need to look at our portfolio when we're always trying to find companies that sort of have stock specific drivers within them. We're looking at high quality companies. We're not always looking at companies that have, you know, catalysts that are going to take to the next level. We're looking for sustainability in our holdings. So, when you look at that, we have a couple technology names such as Broadcom, which is a fairly unexciting name that has mission critical applications that they're tied to with great market shares and just a very modest, consistent growth profile, trading at a very reasonable valuation. So companies like that, we like. We talked about pharmaceuticals earlier. Companies that have good pipelines, good solid drugs, good positioning within the market, and sort of that execution culture uh, that can keep and sustain those earnings. Those are the type of companies we're looking for in the trust. I think for macro backdrop, we are aware of the risks. We'll never be fully insulated, from those as no public company, is, and certainly not, 40 public companies. But I think it's something where we're very careful and selective in our holdings, and we're looking for those that have the ability to get through the hard times and come out, when things get a little bit better, even stronger.